And welcome back. This is the Mortgage Hotline. It is Sunday morning. Thank you very much for joining us here. We were talking earlier about loan modifications as well as any of you investors out there looking to invest in real estate. And if you're going through something right now and we're not necessarily talking about it, we definitely want to hear from you. We want to be your sounding board for all things real estate and mortgage related, because there's a lot of information out there, and we just want to give you some feedback on any experience that you're currently having. So we were talking about, if you're just joining us, we were talking about investors and what it takes to get investment financing in today's market. And Jason and I were talking quite a bit last night, and we're just thinking about what are some of the major issues in the real estate market today. And we came up with a couple things like appraisals. I know that getting an appraisal, your question to me was, well, can we do an investment loan based off of the current value of the property instead of the purchase price? Because if you've negotiated a short sale and it's way below market value, who's to say that the bank is going to hold you to that higher value? You might be able to get a better deal and the property appraises for more. We definitely are seeing that in the market today, but his question was, doesn't your loan to value get based off of what the property will appraise for?
Yeah, my question was, with hard money, why do they? I remember when I was doing hard money loans, a lot of loans, back 2 or 3 years ago, when we were into the hard money loans, it didn't make any. I didn't have to put any money down on a hard money loan. I would just have, not me, but if I was doing it for a client, they would go based just off. That was a difference between hard money and conforming money. Is conforming, they went off the appraisal and the sales price, whichever was lower, and you had to put a certain amount of money down if you weren't doing a 100% loan based on that. With hard money, it just mattered what the LTV is. And when I was asking you about hard money yesterday, you said yes, you would definitely have to put down the amount of money. But I wish it was the other way around, because you could bring a lot more people into the market.
Yeah, I mean, we work with a bunch of different, and we call private money. Hard money has kind of a certain connotation to it, so we like to use the flowers and the rainbows of private money.
Okay, I stand corrected.
So and each private money investor is going to be a little bit different. It just depends on what their underwriting guidelines are, but from my experience, it seems like they're going to do their own independent appraisal, and then they're going to have you come in with 35 to 40% down based off of what your purchase price is. Now, I don't know if that's recently changed, but I know that it's definitely a cause of concern, because I've even heard of another investor that would do that, but his underwriting guidelines and what he's looking for is very, very specific. So there are people out there that would go off of current value, not purchase price. But another problem that we're having is properties actually under appraising. And under appraising means that you're purchasing a property, let's say for $200,000, but it only appraises for $180,000. And so what happens there is typically you'd have to come up with your normal down payment. Let's say for an investment loan, you're looking at a minimum of 20% down. So right there off of your purchase price, you're looking at $40,000 down. And then on top of that, you're actually going to need to come in with the additional $20,000 to bridge the gap. So typically what happens is you either come in with the money or you renegotiate down to the purchase price.
Why would someone want to pay more than what a home is worth right now in a market that could still decline?
That's a fantastic question. I've actually dealt with this a lot in the last week or so. Appraisals are actually coming in low because the market data isn't there to the market data isn't sufficient to give it a proper value. So you have to cut value based on there not being a lot of market data there. What that means is if you've got very few sales in the area for 3 to 6 months, or if you don't have a lot of sales in the area within a 2-mile radius, that could actually lower your value, because you have to go and search outside of the perimeter of those properties, and then you have to bring in other comps that may not be like in kind, and then you have year adjustments for the age of the property and things like that. So I'm working on a deal right now, and it's a great home. It's actually a rebuilt home that this guy's doing. He's rebuilding a home in Cathedral City, and the value's there. We had a purchase contract a purchase price at $225,000, and the value's there. It's going to be a brand new home. It's got granite countertops, all the bells and whistles, but it's in a neighborhood that has older homes. And there's not a lot of market data that's able to support that property value, and so we had to end up cutting it down to like 195 to 200,000. Now
that brings up a good point too. Is that you never buy the biggest house in the neighborhood.
Yeah.
You should really do that research prior to. I mean, because you know what you're going to have. And you know how old it is, obviously, if it's a brand new house or whatever else. You really should, prior to doing something like that, I believe, do that research, because it could potentially pose a problem.
It really can. And now the buyers feel that the value's there, and the seller definitely has spent the money on it. Now the property probably appraises or is actually worth about 225, but the way we put the appraisal report together is as such that we can't sell it to the bank that way.
Right.
And so somebody might actually be interested in bridging that gap because they see the potential there. But most times we have to go in and renegotiate.
Right.
A lot of those reasons is because we are buying foreclosures or short sale properties, and they're either trash houses or they're just not comping out. So there's a lot of information out there right now why people would want to pay the extra money to do that, but more times than not, they are actually reducing the purchase price to put the deal together.
Well, the fact of the matter is that you have to realize that things, I think things are still going to go down a little bit. I know right now they're just going up a few points, but I think it's a calm before the storm because you have the unemployment wave of foreclosures coming. What you also have is over 600,000 properties in the state of California that are not listed as REO yet, and they're yet to come and flood the market.
Yeah, well, you have that, and then you have the last of the ARM.
Yeah, the ARM resets.
The 5-year ARMs.
We're like 95 or 96% of the way through the ARM resets, or the subprime foreclosures that we're going through. Again, unfortunately, we're going to no matter how they sugarcoat it in the media, we are not coming out of this, and we are going to go back into an unemployment phase, as we all have seen. Let's be honest.
So as you're seeing the market change and shift like that, there's going to be a lot of great inventory out there. So as an investor, what are some key points that you need to consider when you're looking at buying properties?
Buy low and sell high.
Buy low and sell high. Banks right now they're really smart. And they're double checking everything.
Have they seen it all, Sean?
They've seen it all.
Been there
and they know if you're buying fix and flips, and they also know that if you're going to buy what's called a bulk sale, if you buy like multiple properties, like 4 to 6 properties at a time out here, I recommend that you hold those properties. But if you are an investor looking to flip properties, one thing that you really need to keep in mind is the FHA 90-day flip rule. And what that says is that if you transfer title when you're not a bank within 90 days of transfer of title, you cannot get FHA financing on the property.
So they need 90-day seasoning.
Yeah. So when I
you
say
got to own it
fix
for
and
90
flip,
days.
Own it for 90
before
days.
You can resell it.
No, you can do that. Now, you can get a conventional buyer or a cash buyer in order to do that, but come on. I mean, what you're really looking to do is have your property be marketable, and you want to have the biggest buyer pool possible.
Right.
So know that you have 90 days that you're probably going to be holding the property. The contract can't be written. You can't open escrow. You can't have the appraisal ordered. You can't have any of the things that you need to start your transaction until the 90th day that you've been on title.
Right.
I had a situation where we were 5 days from closing, and the guy transferred title as an individual to an LLC. We're ready to close the deal, and it's all good to go. But because he transferred it from himself to an LLC, that blew up the 90-day rule, and so we had to start from scratch essentially. So when you're out there and considering that, and you're thinking about putting together your plan and your timeline for fix it and flip, consider that.